99% of people keep missing this. There's a massive difference between financing a primary home and an investment property. And I've seen guys waste over $50,000 on a deal because they didn't know the correct financing options available to them. So in this video, I'm going to cover the loan terms, closing costs, credit score, and down payment requirements, and the differences between financing a primary home and an investment property. So by the end of this video, you'll know what to expect when financing the two, and towards the end, I'm going to cover one secret loan program that my top investors are using in 2025. The first part is the most important, yet the most overlooked. When you're financing an investment property, you have two loan options. You can either go conventional, which is traditional financing, or a hard money loan. That's quick funding, quick cash that you need to buy a fix and flip. Usually, that's when it's used. For a conventional loan, you can use them both for a primary and investment property, but the terms are completely different. I'm going to explain this through a very heartwarming story. Meet John. He's 30 years old, he's a nice guy, and he just got engaged. He proposed to a lovely lady, but there's a problem. He's at risk at losing his fiance because they've been engaged now for a few months, because his fiance is constantly getting bribed by very rich lawyers to come live with them and marry them instead. So his fiance said that the only way he'll stay with John is if he either buys them a new home or at least buys an investment property that they can start earning income with. Now, why in the world is she asking him to do this? Anyway, let's compare the two. Now, when buying a primary residence, meaning you're going to occupy the house within 60 days after closing, you have a few loan options. You can go conventional, 3% down with a 640 credit score, or an FHA loan, which is 3.5% down with a minimum 580 credit score. Or if you're a veteran, you can do no money down, and the credit score requirement is case by case. However, if you want to buy an investment property, the minimum requirement for a down payment is 20%, and that's only with conventional loans. FHA loans and VA loans are for primary owner-occupied deals only. The reason why this is because lenders know that when things go wrong in your personal life or with your business, you are going to sell your investment properties first. You're not going to sell your primary first. And so that's why they want more money down. They want you to have more skin in the game. That's why a common investing strategy, which is effective but sometimes tedious, is just keep buying single family homes every single year with low down payments as primaries. That's why many people buy primary homes every year or every other year, because they want to take advantage of the low down payment programs for those properties, and they just never sell. So if you buy a primary home, let's say in 2025, next year, 2026, you buy another primary, but you never sell your previous property. You can take a home equity line of credit, or you can just leverage it, rent it out, whatever the case may be. But a lot of people do that so that they can keep holding investment properties as they move and buy the next one. It takes longer to do that. It is a little tedious, and you do have to move. Many people don't want to do that, especially if you have family, but it is a strategy. I put a cheat sheet in the description, by the way, if you want to know how to achieve a net worth of over 1.3 million in 15 years using this strategy. It can be effective. Hope it helps. Now, what about interest rates? Let's talk about that. Aren't they the same for investment property and for primary residences? No, they're completely different. Let me show you an example of comparing three different loan programs, okay? So let's say you're buying a primary home. You can either go conventional or FHA like I mentioned. For a $300,000 home, if you notice, you'll see your payment down at the bottom there of $2,037 conventional or $1,970 a month for FHA. For an investment property, you have to put 20% down, which is $60K for our $300K home, and the interest rate's going to be 7.5% versus anywhere from 6.3 to 6.8 in this situation. Now your payment's going to be $1,679 on the investment property. So of course you're putting more money down, but your rate's a little bit higher, right? So that's standard for investment property. The rates will always be higher. Now by how much? It's so different. It's really case by case. It depends on a lot of different factors, but just know that generally speaking, your rate on investment property will be higher. But doesn't your interest rate also depend on credit? Yes, credit is a big factor. It's actually one of the biggest reasons why a lot of investors are overpaying on their loans, because their credit profiles aren't taken care of. Now, what about credit score? Doesn't that matter? Yes, it does. Notice here in John's scenario, if he's looking at three different loan options, right? His credit score is 740, so pretty good. As an investor, they're going to be a little bit more strict, the lenders, on your credit score and your credit profile. When you're buying a primary home, lenders will be more forgiving. Do you notice a trend here? Do you see what's happening? When you're buying a primary home, getting approved is always going to be easier. For an investment property, it's a little bit more complicated than that. However, there's a loan program that's going to help with this, and I'll cover that in the end. Now, most loan options are 30-year fixed for primary homes. For investment properties, you can do interest-only payments. You can do 40-year fixed mortgages. There's a lot more that you have as far as investor loans go. Now, what about closing costs? Doesn't that matter, and doesn't that differ from loan to loan? It does. Now, for investment properties, generally speaking, the closing costs are going to be a little bit higher. For a primary home, not so much. Remember John from earlier? He's buying a house for his fiance. He wants to compare closing costs, right? So for a conventional loan, it'll be around $11K. For an FHA loan, be around $13,000, and for investment property, it'll be $14,000. Now, generally speaking, investment property loans are going to be a little bit more expensive. I have some programs though to alleviate that, to make it a little bit more affordable. If you have any more questions, you can reach out. These are estimates and the market is a little different. So keep that in mind. I'm just throwing estimates. There's over 20 data points that go into every single rate and term and like the pricing differences. So keep that in mind. Now, to break it down simply, there are 4 parts to how closing costs break down. The first part is taxes and insurance. Next is title fees, then escrow and prepaids, and then origination and processing fees if they apply. Okay. Now, these are the 4 main sections that you're going to see whenever you're financing any type of property or any type of deal. Now, for John, if he's buying for his fiance, he has to know some key underwriting tips, right? Gift funds are not allowed on investment property purchases. Okay. The maximum seller credits depends on the loan program and the occupancy type. Okay. There's a cheat sheet in the description below if you want to see a quick guide on how much in maximum seller credits you can get. Now, the way it works is for a conventional loan, if you're putting less than 10% down, it's 3% in seller credits you can get. For an FHA loan, you can go up to 6% in seller credits. Now, for investment properties, it's a little bit less. It's usually around 3%, okay? 2 to 3%. Now, know that for seller credits, you can leverage these to help cover closing costs. Now, Ben, what about the secret loan program you mentioned in the beginning? Well, I'm glad you asked. My top investors right now are leveraging this program in 2025 to scale their portfolio and get to that next level. And what is that next level? That's retiring their parents and not having to work a 9-to-5 job for the rest of their life, okay? So what this program is it's called a DSCR loan. And if you don't know about it already, I've made a lot of videos on it, but basically how this works is it's for investment properties only. It requires 20% down to start, and it does not use personal or business income to verify your eligibility for the loan. So it only uses the potential or current rental income of the property to qualify. What that means is that we're not looking at your W-2 income, we're not looking at your business income. We just want to look at the potential, if it's vacant, or the current rental income of that house that you're buying or that multi-unit. The gross rents must at least cover the mortgage payment. And I just closed a DSCR cash out refinance to 6.75%. So the rates are actually pretty good on these loans, at least for my program. The way it works, you can take cash out of a property or you could buy a potential property using this program. One thing to note though that everybody misses is that they have prepayment penalties. Now you can buy them out in exchange for a higher rate. So like, let's say instead of a 6.75, right? You want to do an 8% rate, but with a 5-year prepayment penalty. You have that option as well. So for my client here, we locked him at a 6.75 with a 5-year prepayment penalty. And then the last thing I'll note that many people don't know about is that it doesn't require seasoning and you can pull cash out right away on flips if the deal makes sense. Sometimes we require 2 appraisals, but just know that if you need cash out right away, it does not require seasoning if the ARV, meaning the after repair value, is there. Here's a quick example on how that all breaks down. Let's say you're buying a $450,000 house, you're putting 20% down. Let's say your interest rate is 8.25 because you don't want prepayment penalties, right? You're going to get a 30-year fixed mortgage on this loan. So the gross rental income is going to be $3,500. Your real estate taxes is $500 a month. Your hazard insurance is $140 a month. Now our total property expenses is $640. We're just looking at taxes and insurance and the mortgage payment. We're not looking at utilities. Now our monthly mortgage payment is $2,704. Our rental income is over that, right? Because they're taking the mortgage payment plus the expenses. You're at a DSC ratio of 104, okay, 104%. That's good. You want it to be above 100%. If you want this calculator, also put in the description as well. It's a quick way to really tell if the loan is going to qualify. And that's pretty much it. That's the main thing that's going to tell you if a loan will qualify or not for a DSCR loan. So those are the key differences between financing a primary residence and investment property. If you're curious to know a little bit more about what John ended up doing, you can reach out and I can tell you directly on what happened to save his marriage and his fiance from leaving him. But if you need any mortgage help or financing for your future projects, or you just want to learn a little bit more on how to achieve financial freedom, I hope a lot of investors get to that point. So my contact info is here. I do all types of financing. You can call or text me, or you can email me at bstef@nexamortgage.com. Hope that helped. I'll see you on the next one.